Hi, everyone. My name is Rebecca Mullen, and I'm the Counseling Department Chairperson at Greeley. On behalf of my colleagues, I want to welcome you to our annual financial aid presentation. We are so fortunate tonight to have two very knowledgeable speakers that will help to explain this process in great detail. But before we begin, I would like to introduce the president of the Horace Greeley Scholarship Fund, Ms. Kristen Mancini, who will share some brief remarks with you. Kristen?
Thank you so much, Ms. Mullins, for having me. So I'm really grateful to be able to speak to you tonight. As Ms. Mullins said, my name is Kristen Mancini, and I am the president of the Horace Greeley Scholarship Fund. For almost 80 years, the Horace Greeley Scholarship Fund has provided financial awards to Greeley graduates to help pay for college. Greeley grads and their families turn to the fund after all other financial resources, including scholarships, federal financial aid, and loans have been exhausted. With our community's help, we work to fill the gap for Greeley students and families in need. The only prerequisite to apply for a grant from HGSF is that the student be a Greeley senior or recent graduate who is currently in college. The fund awards grants strictly based on financial need. Grant applications are kept completely confidential. A committee of the board works with an outside financial aid consultant to review all applications in an entirely confidential process. Last year, we were able to award $500,000 to eligible applicants. You can find more information about scholarship applications, as well as our mission and fundraising events on our website, hgsf.org. Applications are currently open, and we hope that if you are interested, you will look at the site to learn more and begin an application. Thank you, as always, to the wonderful community of Greeley families and students who continue to support each other and HGF's mission of ensuring that every Greeley graduate has the opportunity to attend college. Keep us in mind as you make it through the college application process. Thank you so much, and have a good night.
Thank you so much, Kristen. So now I'd like to share a little bit about the format for tonight. First, we're going to hear from Mr. Nicholas Salinas, the Director of Financial Aid at Sarah Lawrence College and the current financial aid consultant for the Horace Greeley Scholarship Fund. Nick was born and raised in Westchester and started his financial aid career at Fordham University. And after 3.5 years, moved on to Sarah Lawrence, where he's been for the past 19 years. We're then going to hear from Mr. Scott Kahan, a certified financial planner professional and president of Financial Asset Management Corporation, a fee-only financial planning firm that he started in 1986. The firm provides financial planning and investment management services to families and small business owners. Scott has also worked with many families in helping them to prepare for the college process. Scott has lived in Chappaqua for the past 30 years, and both of his children graduated Greeley. He also served as treasurer for the Horace Greeley Scholarship Fund for the 11 years. And he presents every year, which we're super appreciative. This is his 22nd year of presenting in this meeting. Throughout the presentation, please feel free to add your questions into the chat. No one else can see them except for us, and we will address them at the end. And now I'd like to turn things over to Mr. Salinas.
Thanks, Rebecca. I'm just going to share my screen here. All right, great. So we're just going to jump right in and start talking about financial aid. And these are some of the topics that we will discuss tonight. Of course, what is financial aid? What makes up financial aid? Cost of attendance, what is that? Student Aid Index, or you may know it as its previous name, Expected Family Contribution, or EFC. What is financial need and how is that determined? Different types of financial aid. Of course, the FAFSA, the CSS profile, and we'll discuss some special circumstances if those pertain to you. So what is financial aid? Of course, they're funds that are provided to students and families to help pay for your college education for 4 years. And some folks don't really recognize loans as financial aid, but they are a type of resource that is available to you. So just keep in mind as we discuss grants, scholarships, work study, loans are a part of the process as well. Cost of attendance. So this is comprised of two different types of elements. Direct costs, those are the things that you would get billed for. You would see us on a statement of account and what you would have to pay directly to the college. And then there are indirect costs, things that you pay out of pocket. Those two things, direct and indirect costs, equal a cost of attendance. And that varies from college to college because tuition could be different, is different for each college or university. Room and board is different. So the cost of attendance at each individual school is going to be different. So the different type of billed costs and out of pocket here. As I mentioned, any type of billed cost from the college or university, tuition, fees, room and board, some additional cost as well if they are necessary, if your family needs them, health insurance, a health service fee or something like that. Out-of-pocket expenses are things that you have to pay out of pocket, but you are not billed for. So there are additional expenses like books and supplies, transportation to and from college, and of course, personal or miscellaneous expenses. Now, the two of these things make up the cost of attendance, what is used to determine financial need. And we'll get into that a little bit later. So what is an SAI or Student Aid Index? If you've ever completed the FAFSA before, prior to maybe about 2 years ago, you would know it as the expected family contribution, or EFC. You may have heard that term thrown out. So the SAI or the EFC, it is basically the same thing. It functions in the same way. It's what the federal government and colleges use to determine financial aid and financial need levels. So it stays the same pretty much regardless of the college, and it's made up of two components, parent contribution and student contribution, because it is the student's application. So they are filling out the form in their name, but as a dependent student, they will need parent information as well on the FAFSA and the CSS profile, and we'll go through that a little bit later as well. And the FAFSA and the CSS profile, they use the data from, the federal application, which is the FAFSA, is used to determine any type of federal funding that a student or family is eligible for. So determining need, we talked about cost of attendance, those direct costs and indirect costs. And if you subtract your student aid index, formerly known as the EFC again, you will notice, or that will determine what your financial need level is. And that's what colleges use to determine any type of need-based grant that you might be eligible for, or any type of need-based funding that you might be eligible for. Now, of course, cost of attendance minus your student aid index equals your financial need. That is what the government and a college or university is determining your need level at. Of course, what they think your need level is going to be completely different from what you think your need level is. So net price, very important here, because you don't want to necessarily get caught up on the sticker price of a college or university. So in order to get the net price, you take the cost of attendance and you subtract any type of financial aid that you might be eligible for on your award letter, and that equals what you would actually pay for college, the net cost. Something important, really important to know, is that every college or university is required to have a net price calculator on their website. So if you go to their financial aid website, you will see a net price calculator for each individual college that your student is applying to. And you want to use this because it is a great tool to determine a rough idea, a ballpark figure, if your student is admitted to the college, what type of financial aid might they be eligible for. Now, just keep in mind that it's an estimate, and the estimate is only as good as the information that you are providing on the net price calculator. So follow the instructions carefully for each individual school's net price calculator. They are, a lot of them are different, and they would determine aid differently, whether it's merit aid or need-based aid. So it's a great tool to use at each individual college. So make sure you are using that information. And if I could give you a tip, just make sure that you are saving all of the data that you are entering into the net price calculator, whether it's the answers or the results. You should save both. So there's different types of categories of financial aid, need-based. Of course, you have to demonstrate the need for those funds. And by doing that, you have to apply for financial aid. You have to complete all the requirements that a college or university is requiring, that whether it's the FAFSA, CSS profile, tax documents, whatever the college is requiring, you need to submit all that information for them to determine what your need level is and to determine any type of need-based grant funding. Non-need-based or merit awards are typically determined by the Office of Admission based on your application profile, test scores, recommendations, references, interviews. So just keep that in mind as well. So different types of financial aid. Scholarships, of course, is merit funding. Grants are typically need-based. This is free money, things that do not have to be repaid, unlike loans, where you would have to repay those at some point throughout either the education or 6 months after the education. And of course, employment. There are different types of employment opportunities to help fund typically not the billed expenses, but the out-of-pocket expenses, whether it's books, supplies, or entertainment while the student is on campus. So you're going to start receiving financial aid offers from different schools. You want to make sure that you are comparing the net price, and you want to make sure that you are being careful of inflated awards. And what I mean by that is typically a financial aid award letter will consist of scholarships, need-based grants if you're eligible, work study if you're eligible, and what type of loans that the student is eligible for. Typically, that is a subsidized or an unsubsidized federal student loan, formerly known as the Stafford Loan Program. What I mean by inflated awards, there are certain schools who will take the gap, basically, your cost of attendance minus your financial aid, and then they will fill the gap or whatever is left over to pay that net cost with a federal Parent Plus loan or a private student loan as a part of an award letter. So when you're doing your calculations, make sure that you're only taking into consideration the loan funds that are available to a student in the federal format. So federal, subsidized, and unsubsidized student loans. I mentioned before, scholarships are free money. Of course, they do not have to be repaid. And the Office of Admission typically looks at your application based on either merit, skill, characteristic, test scores. They will look at your student's application holistically as a whole and determine if your student is eligible for a merit scholarship. Need-based grants, of course, again, do not have to be repaid. This is free money. And again, you have to apply for these funds. Need-based grants are determined depending on what the requirements of the school are, FAFSA, CSS profile, different types of tax documents that they may require. They also might have an institutional financial aid form that you might have to fill out for those grants. So just make sure that you're taking a look at all the requirements on the financial aid websites of the schools that you're applying to determine what you need to submit or upload to those schools. Now, keep in mind that you will have to reapply for financial aid for need-based grants every year. Merit scholarships are typically renewed each year at the same amount. However, need-based grants have to be applied for every year. Schools understand that there could be a fluctuation or a change from one year to the next based on changes in income, changes in employment. You might be using assets to fund an education. So from one year to the next, those types of financial assets and income could change from one year to the next, and they want to take those into consideration when determining your financial aid. I mentioned before loans. They are a type of financial aid. They are a resource that is available to students and to parents. Of course, as financial aid administrators, we only want students to borrow what they need to make the education financially viable for them. We hear horror stories about students borrowing money to go on spring break or to buy a car or something that is not necessarily educationally based. So make sure you're only borrowing what you really need to fund your education. And you always want to look at loans. While it's funding that you have to repay, it's also an investment in the future. I mentioned before work study or employment on campus. This is also possible at most schools where a student would find a employment position, be paid typically weekly or biweekly for the hours that they do work. Now, this funding does not get subtracted from your statement of account, what you are billed for. This is basically spending money so families do not have to send their student any additional funding over the course of the semester or the year on top of paying for the tuition bill. So if a student is working on campus, they could afford, whether it's going out to eat or entertainment or some of the books and supplies that they need to pay for. Another type of employment is becoming a resident advisor in your sophomore, junior, or senior year. Typically, those positions are available to upperclassmen. So a lot of the times, universities and colleges will offer some sort of discount on room and board if a student becomes an RA and they are working for those funds. Different sources of financial aid, of course, the federal government, states, New York State, private sources, private scholarships, and employers. And we'll get into that a little bit later. So the federal government is your largest source of financial aid, basically based on Pell Grant recipients, different types of need-based grants that they offer, and of course, the federal direct student loan program. And you must apply every year using the FAFSA to be eligible for federal funding. And these are some of the common federal aid programs. You may have heard of the Pell Grant, SEOG, of course, work study, which we touched on a little earlier. Federal loans, formerly known as the Stafford Loan Program, and parents can also borrow a federal loan, which is called the Parent Plus loan. Typically federal loans are repaid after graduation, about 6 months after graduation. So New York State does have, through our Higher Education Services Corporation, a grant program called TAP, Tuition Assistance Program. You have to be a New York State resident, and you must be attending a school in New York in order to qualify, and you have to be registered at least 12 credits, for 12 credits. There is an income threshold for receiving TAP, and it's not cut and dry, but typically we would see income under about $100,000, you could be eligible for TAP. They do take into consideration New York State income tax, and that's how they determine your New York State TAP award. When you complete the FAFSA, as soon as you indicate that you are a New York State resident, it will give you a pop-up indicating, would you like to complete your TAP application now? We recommend you doing that immediately at that point so that you don't have to go back into the New York State Higher Education website to do it later. You might as well get it done as soon as you are doing the FAFSA and apply for it right away, and they will determine what your eligibility is at that point. So private funding sources, foundations, businesses, charitable organizations, you always want to look for private scholarships. There are two reputable scholarship search engines that we typically tell our families about. One of them is capx.com and the other is fastweb.com. What you want to do is have your student set up a profile. Do not provide any type of private information, no social security numbers, no bank account numbers, nothing like that. Everything that you're applying to should be free. So you're just setting up a basic profile, some academic information, and it will determine what scholarships you can apply for. And obviously, there are a number of different scholarships out there. There are a lot of unclaimed funds out there as well every year. So there may be small scholarships, but they do add up. So just make sure that you are applying early, apply often, and they can range from $500 all the way up to, we've seen full tuition scholarships from outside sources. There are also scholarships available through employers. So speak with your human resources office, find out if they have any benefits for dependents attending college. A lot of places have different types of either scholarship, tuition remission benefits, or credit unions where they might have low-cost loans that are lower than federal programming or private loan sources. So tap into any type of scholarship organization that you can. It's a no until you ask. So check with your employers, check with your HR departments, and any other local organizations that you may be affiliated with as well. So let's talk a little bit about the FAFSA. Of course, this is the form that every school who is providing Title IV federal funding is required to use in order to provide you with those federal funding, with that federal funding. It's an online application. It does have a lot of help features. And like I said, every school will require you to complete this if they are participating in federal financial aid programs. Studentaid.gov is where you want to complete that form. Remember, the applicant is the student, but they will require, as a dependent student, they will require parental information. And you can apply anytime during the academic year, but every school will have their own priority deadline. So make sure that you know what those deadlines are and make sure you complete the FAFSA by those deadlines. Now, if you've kept up with any of the financial aid news, you may have heard that the federal government, the Department of Education, has simplified the FAFSA. That remains to be seen. However, I'm a little cynical because it has been quite a nightmare for financial aid offices, for our students and families to complete the process. I'm sure you're well aware of this. So it is functional now, and they're still working out some of the kinks from the 24-25 academic year. So we are being told, financial aid offices are being told by the Department of Education that the 25-26 FAFSA will become available on or before December 1st of this year. We are keeping our fingers crossed. We are doing everything that we can as financial aid administrators to make sure that our families are getting the information that they need. So just be aware that this upcoming cycle, the FAFSA will become available on or before December 1st. Any of the schools that you're applying to will have updates provided to you, whether it's on their website or they send you an email. And I'm sure you'll hear it in the news as well. So when you're completing the FAFSA for the 25-26 academic year, they will be requesting 2023 federal tax information. You have to provide consent on the FAFSA by a digital signature in order for the IRS to use your tax information from 2023 to import into the FAFSA. And that's how the schools will get that information and be able to use that information. If you do not provide consent, schools will not be able to determine what your SAI is, your student aid index, and we would not be able to determine any type of financial aid for you. So just make sure that you are checking all the boxes, using all the help features, and make sure you get it in by the deadlines. So I mentioned before, typically the availability date of the FAFSA is typically October 1st of every year. The last couple of years has been an anomaly because of the FAFSA simplification. So we are looking forward to the time, hopefully 26-27, when they can revert back to the original date of October 1st being available for our students and families. So just keep that in mind, that this December 1st availability date is unusual. And we're hoping for an October 1st availability date going forward after this year. In recent years, the number of questions has decreased from 100 to less than 50. So they are trying to simplify it. Just operationally, it unfortunately did not work as well as they thought it was going to work. We mentioned before the expected family contribution language is being replaced by SAI. And unfortunately, for the FAFSA, the discount for families with multiple children in college is no longer available. So that was something that just went into effect in 24-25, this current academic year. So this is only on the FAFSA. There are some schools who are still taking into consideration multiple children in college, and they will take it into consideration when determining institutional funding. This is important because you may have been planning on, a discount with that EFC or the student aid index being split between possibly, two children in college. The FAFSA is no longer doing that. However, there are some schools, a lot of them, who are using institutional funding to take into consideration multiple children in college. You can ask each financial aid office if they are doing that. They would likely have something on their website indicating so as well. So just something very important to be aware of. The federal Pell Grant eligibility is now tied to the number in the family and poverty level. And for divorced or separated households, the parent who provides the most financial support is required to complete the FAFSA. Previously, it was the custodial parent. Typically, the custodial parent is the parent that the student resides with most of the time, so more than 50% of the time. Now, the requirement is that the parent who provides the most financial support is to be completing the FAFSA. I will go over a little bit of that with the CSS profile and how that is impacted in a bit. Oh, it is the next slide. So if you are applying to a private institution, it is very likely that they will require the CSS profile, which is another financial aid application. And most private institutions will use this to determine their need-based institutional funding. The major differences between the profile and the FAFSA is that home equity is taken into consideration on the CSS profile, not on the FAFSA. So you will be required to fill out information about the value of your home residence and the debt that is owed on it, so that they can determine the equity. They believe that the equity in a home is a measure of wealth, not necessarily what you can use to contribute to college, because there are not many families who are borrowing against their home these days to fund an education. I can say when I first started in the industry, the rates were lower. The rates were really low. So families had an opportunity and an option to use home equity and to borrow a home equity loan, which was borrowed at a lower rate than a federal Parent Plus loan or a private student loan. But these days, families are not using home equity to fund a four-year education for their child. A lot of families are using their home equity as a retirement nest. And so we at Sarah Lawrence used to be a CSS profile school. We felt that it was not an accurate measure of a student's or a family's ability to contribute to their education. So we removed the CSS profile as a requirement about maybe 5 or 6 years ago. Another big difference between the profile and the FAFSA are that all parents involved will have to complete a CSS profile. So if there is a divorced or separated household, and let's say, for example, worst case scenario is that both biological parents are remarried. That means there will be, and if all four parents, that includes the step parents, are working, all four parents' income and asset information will be taken into consideration on the CSS profile to determine financial aid. So that is a big difference. Whereas the FAFSA, only the parent who is providing the most financial support. If they are remarried, then yes, the step parent, the new spouse, would have to be included in that on the FAFSA as well. The profile is typically a little longer than the FAFSA. They ask for a lot of information that schools use for data, but not necessarily in the financial aid review and determination of need-based aid. So the FAFSA does not have a area to include any type of special circumstances. You can't report that on the FAFSA. So what you want to do is the CSS profile, if you're applying to a CSS profile school, they do have a special circumstances or explanation, special explanation box that you can, a text box that you can include. We always recommend, if you're going to include anything on that text box, make sure you are putting it in a email or a Word document that you can send to each financial aid office. Any information that you think the financial aid office should know that may not be on the FAFSA or on the CSS profile, you may want to send a letter directly to the financial aid offices so that they are very well aware of what's going on. And these are the different types of special circumstances that we have seen predominantly. There's always a reduction in income from one year to the next because a lot of the times, so when you're filling out the FAFSA for 25-26, you're going to be using 2023 information, income information, which means anything could have happened in the last year and a half to 2 years from the time that you are applying to college from, a year and a half, 2 years ago. So if there's a change in income, you absolutely want to document that. The college might ask you for an updated tax return. So if you have a 2024 tax return coming up in January or February, you want to submit that to the office and ask them if they can take that into consideration, because it is a more realistic picture of your family's economy at that time. So out-of-pocket medical expenses that insurance does not cover, you also want to include that. If it is a large number, especially, they might ask you for some documentation, some canceled checks, or a billing statement from doctors. Provide any information that you can. Again, it's a no until you ask. So just make sure that the financial aid office has all the information that they can to determine a valid financial aid offer for you. Change in marital status could possibly be considered as well. And just make sure that you are updating, whether it's in the first year or in a student's junior year or senior year. Make sure that the financial aid offices have all the information necessary to make an offer that is appropriate based on your new family circumstances. So just make sure, to close out, make sure that you are aware of all the financial aid and admission deadlines that every school is providing, whether it's early decision you're applying to, early action, regular decision. All those cycles will have different deadlines. Typically, the admission deadlines will match up with the financial aid deadlines. Just make sure you keep them in your calendar, make sure you're aware of what they are, and get all the documents in so that you're applying on time. And that's it for me. If you do have any questions that you do not want to ask during this time, after Scott presents, feel free to take my email address. I'd be happy to answer any private questions that you might have that you may not want to ask today. Thanks, Rebecca.
Thanks, Nick. And now we're going to turn it over to Scott, who's going to talk about how families can pay for their college education. Scott?
Great. I'm going to share my screen here. Okay, so I'm going to, as Rebecca mentioned, I've been doing this for a number of years, and I'm a financial planner in town. And as Nick said, I'll start off with, if you have any questions afterwards, always feel free to reach out to me. Here's my information, get it from the school as well. So, what people find intimidating now that they've gone through this, fill out the forms, and we find a lot of people in Chappaqua, don't have the funds to pay for college. So, your kids are juniors, seniors, and now what do we do? So I'm going to cover a few things here. The Coverdell, different types of college savings vehicles here. Coverdell savings accounts, Roth IRAs, custodial accounts, 529 plans, New York Saves plans, and then other ways to pay for college, home equity, 401k, and then student loans. So that'll be the next part of it. So, okay, as we go through this, the Coverdell education savings accounts, ESA, they're really not used much anymore. There's an annual limit of $2,000. It's tax-free growth when money is used for college, for education expenses. It can be used for elementary and secondary school. Obviously, in Chappaqua, you're not worried about that. There are limitations. If your income falls above 220 if you're married, or 110 if you're single, you can't fund it. Below these amounts, you can fully fund it. In between it, it's phased out. If it's not used by the time the beneficiary turns 30, there could be a 10% penalty, or it can be gifted to another beneficiary under the age 30. You get to choose the investments, usually open it up with a bank, investment company, mutual fund company, brokerage firm. And it's considered the beneficiary's money when applying for financial aid. And that's important because if it's a parent money, parental asset, the percentage of the assets is counted as much lower. I think it's about 5.6 or 6%. If it's a student's asset, it's a much higher percentage. So the idea is not to have much money in a child's name. Roth IRAs, it's a retirement vehicle. There's no tax deduction for contributions. The money grows tax-free. You must have earned income to fund it. So that would be earnings or self-employment income. Here's the 2024 limits, 7,000 or 8,000 maximum if you're 50 or older. Contributions can be withdrawn tax-free and penalty-free for college expenses at any time. The earnings, if they're withdrawn before 59 and a half, are penalty-free if used for college, but are taxable if held less than 5 years. After 5 years, you could withdraw them without any penalties. There's modified adjusted gross income. Here are the limits that if you fall above 240,000, you can't fund it. If you're married, or 161 if you're single, and below, this actually should be 147 here, 147 or 230,000, you could fully fund it. Now, one of the things I'll say, and I'll say probably a couple times when I talk about 401ks as well, you cannot borrow for retirement, but you can borrow for college. So even though a Roth IRA can be used, it is not something that we usually recommend doing, because in most cases, if you're pulling from your IRAs, have you done financial planning to figure out your retirement needs? And what I'll also add in, financial planning, college funding is one part of a financial planning program. People have to look at all your other goals and objectives to really figure out how much can I afford for college, and how do I pay for it without sacrificing my other goals and objectives. And usually retirement is a big one. So you want to look at everything together and holistically before you dive just into one area of it. Custodial accounts, and these are usually your typical UGMA or UTMA, Mary Smith custodian, for the benefit of a child's name. It's the child's social security number. You can give anybody in any given year, for any reason, $18,000 per person without filing any kind of gift tax forms. And there's no tax when you file it, but that's, we're not going to get into that. But you can fund, parents sometimes or grandparents will give grandchildren $18,000 or maybe less. When you fund these accounts, it's considered a child asset again when applying for financial aid. So many times we don't like to see these when people are applying for college and need financial aid, because this money will need to be used and heavily counted, and could hurt their chances of financial aid. The other thing is, the child has the right to withdraw the money at either age 18 or 21. And we've seen cases where kids have, $100,000 or more in these accounts, either through gifts from parents, grandparents, and now they're turning 18, or if it's 21, and they want to buy a car, they don't want to use it for college or whatever. It is the child's money. And that's something you have to consider. So ideally, what we tell people, and we'll talk about 529s in a bit, when family members want to give gifts to kids for birthdays or whatever the reason, fund 529 plans. And again, I'm going to talk about that in a few minutes. It's also subject to the kiddie tax. Years ago, these were taxed at a child's tax rate. Today, they're taxed could be at a parent rate. So under the current law, the taxes, certain investment income of children at their parents' higher tax rates if they're under 18. So any unearned income, and that would be investment earnings, dividends, capital gains, whatever, in excess of 2,500 is taxed at the parent's marginal tax rate. So what happens is you're giving up control of the money. It could be taxed at a parent's tax rate, so there's no tax savings, and it may not wind up being used for college. So you've got to be very careful when you have these type of accounts. And people always say, "How do I get the money out?" That's a different conversation at another time. And the other part, the law applies to dependent children under 19 and dependent full-time students under the age of 24. So this is something to, be careful about with tax planning. Okay, so 529 plans, and I encourage people to fund these. It is the best saving vehicle for college. As you can see here, it's tax advantage. If it's used for college, it is a tax-free growth, but it's named after the 529 of the Internal Revenue Code. It's administered by state agencies. Every state, I believe, has their own 529 plan. Some have multiple ones. So if you're looking at here, ownership by the contributor, the child is the beneficiary. So for FAFSA implications, it's based on who owns the account. Usually that's the parent. Some schools, I've been told, and Nick can probably answer this better than I can, some schools don't look at the 529, some do. Again, that could be a state, school by school. State-sponsored investment programs, every state will have a different one. You can fund any state plan. Residency may be required if the tax deduction is allowed. So in New York, and I'm going to cover this touch on it again. If you fund a 529 plan, if you're married, filing joint, you can deduct up to $10,000 from your New York tax return. If you're single, it's $5,000. That is not per child. That is a total amount. So if you fund for 2 or 3 kids, $10,000 each into a 529 plan, you can only deduct $10,000 each year. So that is a limit. There's no income limitations, though. You could have a lot of money, be making hundreds of thousands of dollars and not worry about, like the covered education IRA. The account owner controls the money, not the beneficiary. It qualifies for the $18,000 annual gift tax exclusion. So if parents want to put $36,000 in for one child, they can do that. They can fund 5 years up front without filing any kind of gift tax forms. And just quickly, gift tax doesn't mean you pay tax on the gift. It means it's used to offset your amount that you're allowed to pass on upon death. That's at this point $10 or $11 million. It's going to change, so it's not something that's usually a concern. If it's not used for the named beneficiary, it can be transferred or used for any other family members. Sometimes parents, haven't used it. Their kid got a scholarship. Maybe you have another child, you can transfer to that child. Maybe a parent wants to go back and take classes. You can use it for yourselves or immediate family members. And I believe cousins as well, not that you're looking to give all the money away, but there are ways of using that money. Since it's considered an asset of an owner, should not be considered the child asset for financial aid unless the student is the owner. Now, what happens sometimes we see custodial accounts that parents want to move that to a 529. Now that becomes a custodial 529, which means the child actually owns it. So that may not be the best way of transferring that money out of a custodial account. Now, if the grandparent's the owner, only income when distributed is reported on the FAFSA. So the asset is not, but the income is reported in the year it's reported. And there's different ways when you start taking money out of the 529s, and depending on who were the owners of it, do you do it each year? Do you do it in the 3rd or 4th year, the 1st or 2nd year? So there are some strategies tied into the timing of when you take money from a 529 to use it. If the beneficiary receives a scholarship, the earnings on the amount withdrawn would be taxed at the scholarship recipient's tax rate, which is usually lower, but not subject to a 10% penalty. Or you can change the beneficiary. So what happens here is that when you pull money out of the 529 when it's not used for college, it can be subject to tax and 10% penalty on the earnings. So just something to keep in mind, and that's why you want to use it for school. Can be used for private K through 12 school at times, but again, I'm sure that's not a consideration here since it's a public school here. Now, this is something new that started. Beneficiaries are permitted to roll over up to $35,000 into a Roth IRA. So if the beneficiary never used their 529 or has money, they could theoretically roll it into a Roth IRA, which then grows tax-free. It's subject, though, to the IRA contribution limits, and the 529 must have been open for 15 years or more than 15 years. So it's not something that after, son or daughter graduates college, 3 years later, you have all this money that you're going to roll it over. It's going to be subject to the limits, and that's $7,000 a year right now. And it has to be open for at least 15 years. So we're talking, many years down the road. So it's really hard to know how this is going to, be used or not. Now, the New York 529 direct plan. So New York has a couple of different plans. We always recommend the direct plan. It's managed by Vanguard. You promise new contributions can be invested within 20 target enrollment portfolios and 14 individual options. You can choose up to 5 investment options per account. So you can target what year your child's going to graduate to put that money in. So if you may have younger children at home that aren't going to go to school for a few years, but targeting when it's needed, because what happens with those portfolios, as you get closer to needing the money, the accounts automatically become more conservative. Because the last thing you want to do is have a lot of money in an equity fund or 100% equities, and all of a sudden the market takes a 20-30% hit when you need the money. So this automatically will time it for you. The other part of it is you can have up to 14 individual options through Vanguard funds that they offer as well. So you can structure your own portfolio if you want to do that. You're allowed to make a couple of changes a year between the different accounts, investment options. It can't be funded once all accounts for one beneficiary reach $520,000. I don't think it's usually not a situation that people are worried about, because if they get to that amount, they've got enough usually to pay for college. If you had that kind of money, you can fund other state 529 plans. Keep in mind, though, again, if you want that tax deduction in New York, it has to be for a 529 in New York State, one of the New York plans. The other question sometimes comes up: if I have a plan in a different state or in New York, can I use it for schools out of that state? It can be used for any accredited college, university. It does not have to be in the state that the plan is in. It's very flexible. I mentioned the $10,000 annual tax deduction for married couples, or $5,000 for single filing. Again, that is only that's a total amount, no matter how much you put in for, no matter how many children. Details can be found. Here's the website, at nysaves.org for the 529s. Now, other ways to pay for college. Home equity, as Nick mentioned, it's much more expensive. I mean, sometimes we do see people, take it, if they've got a lot of equity in their house where maybe they're going to downsize or sell their house, use those funds, but make sure it fits into the financial planning models that you need to look at for your retirement, for your other goals and objectives. But with interest rates where they are now, it doesn't really make sense. Even though rates are coming down, they're still, between 7 to 9%, and it can be expensive. 401k plans, you can borrow against the 401k. You can do a hardship withdrawal sometimes to avoid paying a penalty. You have to check with your 401k provider. But again, if you're doing that, that's a retirement vehicle. You can borrow for college. You can't borrow for retirement. Student loans, I'm going to talk about this in a minute. You have the Stafford loan, which is, the federal loans now. Supplemental, they're subsidized or unsubsidized. The difference is subsidized. The interest rate, payments aren't due until after graduation. Unsubsidized, you don't have to make payments, but the interest starts accruing a few months after you get the loan. Supplemental, unsubsidized, and Stafford loans, which I'll get to as well. Federal plus loans. And those are, parent plus loans. So with the Stafford loans or the direct loans, there's a limit each year of how much you can take, and there's a chart I'll have in a second. You'll see it. With a federal plus loan, parents can borrow up to the cost of college, but just make sure that you can afford to make those payments. And then there's private loans. Before I get to the rest here, I will say that we usually recommend federal loans first. People may find cheaper private loans, but I've seen it over time, and especially during the pandemic, the government waived interest and payments. You don't see that on a private loan. We saw people have a private loan, they had to make their payments. Whereas with the federal loans, interest stopped accruing and payments were waived. So we always recommend starting with the federal loans, the direct loans for the students, as well as the federal, the plus loans for the parents. Even though the rate may be a little higher, there's a lot more flexibility. The other thing, as I mentioned, if your child goes into public service, school teachers, medicine, both these type of loans as well as graduate loans could be forgiven. They have the Public Service Loan Forgiveness Program, PSLF. And I've had a few clients fill out the forms that they didn't even realize that after 10 years of payments, that can be forgiven if you're in the public service sector, 501c3 type organization. Could be, you know, in all honesty, my daughter is a fourth-year resident in orthopedic surgery, and she's got medical school loans. She stays in the public service side, working at hospitals or whatever. She can have her loans forgiven. She's got about 5.5 years left. So it's something to consider. We've had clients that school teacher didn't even realize that, you know, this was something, and they were able to, you know, have that forgiven. As mentioned earlier, the Horace Greeley Scholarship Fund is a great resource. I mean, as mentioned, I served on the board. I did 2 terms and total of 11 years as a treasurer. And when I started, we were giving out small amounts. I mean, I think when I left, we were giving out 170,000 a year. To hear it's 500,000 now is unbelievable. And parents used to ask, you know, they don't want to, you know, give the information because they don't want other people to know their finances. It is confidential. And I know that from working on it, and I would say to parents, it's something that you should really look at because it is a great resource in the community. And then you have the Excelsior Scholarship New York State programs. It's free SUNY, CUNY, and community college tuition for families with federal adjusted gross income of $125,000 or less. It only covers tuition. It does not cover other room and board expenses or so. So here's a chart, and again, this presentation, Rebecca has it, or you can share it. So you have the federal direct, Stafford subsidized, additional unsubsidized, parent plus, and private loans. So when you look at the borrower, here it's the student, here it's the parent. When you look at interest rates, you can see the federal direct Stafford this year for the 24-25 academic year is 6.53%. There's a loan fee of 1.057 that's deducted out. There's no credit check. So it's a good resource. Next year, I mean, if it's based on the 10-year Treasury note, plus I believe a 2.05 index. So if Treasury notes right now are a little over 4%, if they get down to 3.5%, that rate should come down a bit. I don't think it's going to come down, you know, 2 or 3 points over the next few years. I just don't think interest rates are going to go that low. For the parent plus loan, you can see it's at 9%, a little over 9%, and there's a fee as well. There's a credit check, but I mean, unless there's something, you know, in a bankruptcy recently or whatever, you can have a terrible credit score and usually get approved for these. So that's important. The annual loan limits for the subsidized freshman year is $3,500, sophomore year $4,500, and then $5,500 a year for juniors and seniors. Then there's the additional $2,000, which you can get as an unsubsidized. So again, the subsidized, where there's no interest accruing while you're in school, the unsubsidized part, interest accrues. You don't have to make payments until after graduation, or you can. Now, the thing to keep in mind, many times in the financial aid letters, parents will get, you know, where they find out they didn't get any subsidized loans rather. You can still borrow the full amount of $5,500, $6,500, or $7,500 in each of those years, even if it's all unsubsidized. Just because you don't get a subsidized loan does not mean you cannot take out the $3,500 in the first year plus the $2,000 unsubsidized. So you can see the aggregate loan limits here of 23 and then 31,000. Repayment begins 6 months after graduation or drop to less than half-time enrollment. Its repayment is 10 to 25 years. It's eligible for federal loan deferments and forbearance. And again, that's the same for all of the programs here on the federal side. On the private side, you're not going to have that flexibility. You have to make the payments, even though there may be lower interest rates. You have to really search very carefully and know what you're getting into, because there could be triggers that all of a sudden the rate jumps up. But again, after the pandemic, and when they got rid of the interest payments and the payments for a few years, it was a big thing. The other thing is with the different types of programs to pay it off, there's a bunch of different ways of paying the loans off in the federal side that you can, if somebody goes back to school, they can go back into deferment. You can pay it out over, like it says, 10 to 25 years. You could be based on income payment, based on your income. So there's a lot of flexibility with the federal programs. And with that, I know I've gone through things quickly. It's my background, so I'm going to stop sharing here and turn it back over to Rebecca. Again, if people have questions, feel free to reach out to me at any time, not a problem.
Thank you so much, Scott. So we're gonna take some time. I see that there's about 21 questions. So the three of us are gonna go through those and answer them for you. Nick, I have a first one for you. When is the FAFSA due for the 25-26 year, and does it benefit a family to submit it earlier than the deadline?
So the deadline is based on every school that you're applying to. They'll have their own priority deadlines. You can fill out the FAFSA anytime during the academic year, but you want to make sure that you're filling it out with the priority deadlines in mind from each individual school that you're applying to. So I would say, if you are applying for financial aid, as soon as it becomes available in December, you should complete it.
I also just want to take a second to tell all my seniors out there that this week the SUNY apps are free. So it's a great time to submit your SUNY app between tonight and November 3rd because those applications are free. Here's a question. So TAP is for both public and private New York State-based schools? That's the question.
Yes, that's correct.
How does the FAFSA affect early decision or other decisions around early admissions? For example, some early action deadlines are also merit aid deadlines. For example, USC.
Yeah, so if you're applying early decision and the FAFSA is not going to be available at that point, the school will have to determine a preliminary financial aid award somehow. So check with the school, USC, to find out if they are requiring you to submit tax returns or the CSS profile, because that's what they're going to use for a preliminary award. And then once the FAFSA becomes available, they're going to want you to complete that, and they will make any adjustments necessary using the FAFSA information.
So on the common application under the My Colleges tab, there's a question for each school, and they ask if you are applying for need-based financial aid. If a student indicated no by mistake and already submitted the application, can they go back and change it?
Yeah, so unfortunately, you can't go back and change it. So what you want to do is whoever received the Common App, you want to contact their admission office to let them know that you accidentally checked no, you do want to be considered for aid. They might want something in writing from you, just an email indicating that, and they can make the change on their end.
So this question is coming up a couple times, so I'm just going to ask it one more time. You addressed it, but is there any benefit to getting the FAFSA forms in as soon as they're available?
So so schools will have priority deadlines as long as you're getting it in by the priority deadline for each school. And I believe the FAFSA allows you to indicate up to 20 school codes. If you're applying to more than 20 schools, you will have to wait until one of those schools receives the FAFSA, remove, one or two of the schools, and then put in the 21st and 22nd school that you're applying to. There's not necessarily a benefit unless the school is saying, first come, first serve, so you want to make sure that whatever school you're applying to, you follow the guidelines that they are providing. If they want you to, if it becomes available December 1st and they have a January 15th deadline, you got to make sure that you get it in by that deadline.
Scott, there's a couple questions for you. One parent writes, just to clarify on the 529 plans, it's the owner, not the beneficiary, that determines how the asset is counted. Is that right?
Yes, it's the owner, which is usually the parent or a grandparent, and sometimes that's even better. Again, as I mentioned, though, if it's a custodial 529, where you took a custodial account, that's a child's account under their social, where the parent is the custodian, and transfer that into a 529, that becomes a child's asset at that point. It's rare we see that, but something to be aware of. But yeah, it would be the owner.
A similar question, can you transfer part of the 529 account to create a second 529 for a different child?
Yes, you can. And, sometimes we see where parents funded equal amounts for each child. Sometimes we see where parents put it all in one child's name. At the end of the day, you can use the money, you can transfer it. It's pretty straightforward. The only thing we've seen sometimes is when it's all in one child's name that, the sibling finds out that, my brother or sister has this big account. Why didn't they fund for me? And, that's more of a family dynamics issue. But yeah, it can be moved easily.
There's a question, I think this is also for Scott. What is the difference between a custodial brokerage account and a 529?
Yeah, 529 is named after the IRS code 529. It's specific for college funding. And it grows tax-free as long as it's used for college. A custodial account is just an investment account that children cannot have their own investment accounts. It has to be in a custodial account until they turn 18. So it's taxed just as it would be if the parent owned the money. Only that it could be taxed at the parent's tax rate or the child's, and it could be used for anything. It's not necessarily a college funding vehicle, where 529 is specific for college funding.
Okay, Nick, I see this being asked a couple different ways. Should a family fill out the FAFSA even if they think they probably won't qualify for financial aid due to their income?
So yeah, so this is a good question because there are certain schools who may require you to fill out the FAFSA and the CSS profile, if it's a private institution, to even determine merit-based awards. They might be need aware, which means they're looking at financials from families and they're determining how much of a merit scholarship they can offer you without going overboard. So if they can get away with, offering you a $10,000 scholarship instead of 20, they would likely do that because they see that you can afford it. So be very careful with how a school or an admission office is determining their merit eligibility. You can call them, you can email them. It might be even on their website that indicates, in order to be eligible for merit eligibility or consideration, you have to file the FAFSA and the CSS profile or whatever their requirements are. But they would tell you what you need to do.
Okay, Scott, I have one for you. If a family has two 529 accounts for each child, but the parents are the owners, do they need to disclose the amounts that they've saved for the other child?
I'm going to answer, but I'm also going to pass some of it to Nick. My understanding is that it's the parent is the owner, so it's a parent asset. So they don't necessarily have to disclose the 529s for the other children, but I've also been told from some financial aid directors over time that it's a parent asset, so they want to see everything. And I'll let Nick jump in if there's to clarify some of that maybe.
Yeah, so it's actually both. So on the FAFSA, if it's a parent asset or a student asset, it goes on the FAFSA. If it is if it's any other person's asset, like let's say a grandparent, you do not want to report it on the FAFSA. However, if it's a CSS profile school, they specifically ask if you are being provided funding, including 529s, from anyone, from any resource, from any source, parent or otherwise. So typically you would have to report that on the CSS profile. even if it's not a parent.
Okay, we have another question. How is financial privacy handled between divorced parents, or is there none?
So schools are required to keep financial documents separate, private, and one parent should never have access to another parent's information. And typically, unless a parent is providing the student with the documents to, let's say, email or upload, the student would not have access to that information either without written consent from a parent. So you should feel pretty safe knowing that schools should be keeping that information private and it is not released to anyone outside of the financial aid office.
Here's another one. For students who graduate in 2026, do they need to complete the FAFSA after December 1st, 2024?
So they're graduating in 2026, May of 26?
Yes.
So then they would be attending in 26, 27, which means they wouldn't fill out the FAFSA until next year, the following year.
Okay, it looks like that's all the questions. I'll just give it one more minute to see if anyone wants to add any last ones. I will say there are some very specific questions that I think would be better asked in an email either to Scott or Nick. So if it's a very particular question, I would encourage you to send the email. Here's a question. How do you report self-employed income when schools are asking for gross or total income? Would it be adjusted gross income reported after the applicable deductions?
Yeah, usually it would be the adjusted gross income after deductions.
Okay, that is our last question. So thank you both to Nick and Scott. I really appreciate you supporting our Chappaqua families this way. And for everyone listening, we will be sending this recording out in the morning with the attachments included. So thank you, everybody. We appreciate you watching us tonight. Have a good night.